Hello, everybody. Hope everyone had a good holiday. And this is for you, Nareej. I normally don't follow the Nifty, but I took a look at it. And actually, it's one of the strongest global indexes out there. When we were making new lows and taking it out, the US and many other bourses, the Nifty really just retraced, even the daily on it. We rallied back to major resistance at 11. I would say that if we start getting closes back over 11,000, we could challenge the highs. Okay, so that's my view. As far as the U.S. is concerned, here's your 4-hour chart. And if you're not participating, you probably look to buy some type of break here and manage your risk under this low. Or if you're an investor, you would have to get out under 10.3. Is that helping you? Does that help, Nareej? And Stephen, you can see my charts now, correctly? Correct? Boy, my volume is loud. Okay, so let's get back to what's happening here today. And everyone knows that, you know, we had a collapse Monday, and then we had a huge rally on Wednesday. And I'm looking at this, and if risk on is going to continue, this to me looks like a bit of a bull flag in US dollar yen. So I'm not saying the yen is good, because really we didn't diverge down here, but it looks like a bull flag. And I would expect if risk continues, you know, we're giving up 38%, huh? How about that? Because the S&P's rallied 100. Now they're down 38. Maybe it's just a 38 fib. Maybe we're going to go down 50. We'll see if this low holds. A lot of these indexes are giving the same type of pattern, you know, from peaking and seeing if we're going to consolidate. We're not even close to halfway back. So far, it's been about 38% back on this move. A lot of people are saying, is that it? And are we up and away? And too early to make that call. In fact, there still are some calls for 22.40 or so. We'll see if that manifests. I wish a dollar would already come out of this range one way or the other. How tedious it's been pretty much for a few months in this range. So still looks like it wants to come out of here to the upside one more time. Officially, we'll get a correction starting to the downside back under 96. That's 87 underneath there. Okay. And metals have had a great run. Safe haven buyings come in. Silver exploded to the upside actually yesterday, and we have some follow through up here. So all along, we were talking about if there was going to be a continuation move in silver, we could go to 1540 or so, 1550, and in the gold, 1280. 1287. So gold reversed yesterday, but maybe we're still going to make another push up. I believe it's going to start moving counter trend with the market. And the other reason that the yen might pop a little bit more is what's happening in yields. Okay, so we're back near the lows here in yields, but this is a pretty important area, as you can see by the green line. And if we just get some type of correction, call this a half a point, we could rally back to 295 yields 3, but that's going to take the S&Ps having to hold yesterday's short squeeze. And people say, how do you know it's a short squeeze? Because every move, major decline, starts off with shorts covering before new longs enter. So I would call yesterday's rally in the indexes short squeeze, and then you see on the pullbacks if new longs start to come into the market. So that's yet to be determined. I have a hard time wanting to look for lower yields from here, although after we get a rally back to here, it is possible under 274 that we could trade 2.25. That's what the measured move would be. In fact, I have an interest rate guest today, Edward Harrison. I hope Edward is up from his Christmas holidays. and he's going to be with us today. He's an expert in the credit markets, also has a view on the dollar, and it should be a great interview. Looking forward to speaking to Edward. He's one of the better minds in the credit markets. We'll ask him about the corporate debt and stock buybacks, and if all the money that the corporations got on their corporate tax cut has been squandered and not used for new plants and equipment and investment, but only for stock buybacks, which they were buying an asset now under pressure. So I believe the whole team is in the house. We're really looking forward to a great 2019 with our trading family. I encourage you to spend $1 and sign up for our trial. The link is here in the room. Someone was asking me about one of our pattern and plays, and I said he would get a lot of answers for $1 by just cruising our site for 10 days. And that way you get to see our pattern and plays. You get to check out our, okay, you get to check out all of our analysis on all the pairs in Elliott, harmonics, basic technical, candlestick, and macro. And you get the news feed. You could customize this feed. You could have your Twitter. I know a lot of people are active on Twitter. I'm a Twitter anonymous guy. You could have your alert history of all the pattern and plays, and then here we have some active pattern and plays I'll let you see. Stelios took a macro short position here in USD. No, most likely, besides it being technical, is we had a pretty good rally in crude. It's giving some back today. Andre does harmonic works. He's excellent. And we all know what Steve Volge could do. So Steve caught that big up yesterday and shared it in private member chats in the WTI. And he spends a lot of time in members chat, and let alone Blake lives there for most of the trading days. So when FACE is over, people congregate there. So again, I recommend you take the risk of $1. If you're watching this broadcast, you risk 100 times that every time you click your mouse. So with that being said, Blake, have you survived Christmas, buddy?
Hey, Coach, how's it going?
Good, man. How are you?
Good. I'm tired. I'm not gonna lie. I'm worn out. It's getting up early. It's pretty chilly here for Arizona, and getting up early in the morning is tough.
Yeah, I bet it got down to maybe, let me guess, 30 or so in where you're at in the morning?
Yeah, like 40.
It's the new ice age. People are, there are people that say everyone's talking about global warming. There are a lot of scientists talking about global cooling. And, when it got down to 20 here.
Oh,
and I'm
man.
in Southern California. So
wow, that's chill.
I haven't had to like take ice off the windshield since I left Chicago. So
wow.
it brought me back.
Wow. Well, here, I'm trying to get back into the swing of things. There was obviously a lot of big moves in illiquid markets, and that's like kind of the risk when you're during this time of year is that we see some pretty big moves.
Stocks are officially bipolar now.
They are a little jacked up. Hold on, I'm sorry. I'm just trying to get you over to the right screen here. We saw some pretty decent moves in the market. Well, the FX market has been really unmoved, but if you're just trading like just the dollar as a whole. But I mean, the S&P, man, what a big move lower. I mean, we almost hit the 261% extension of the last move higher. I mean, that shows you the magnitude of the sell-off that we saw.
I wondered why it stopped there.
Yeah, I mean, that's one of those golden fibs that you're like, okay, well, that's
the plunge protection team probably look at fib extensions. What do you think?
Oh, I would think so. You know, I
Yeah.
would think so. And we came really close to the major trend line. If you look at like the weekly chart, you know, very close to the, and you could argue that we actually hit it. I mean, you know, it just depends how you draw this trend line. I mean, you could go like that and say, okay, well, we actually hit it because I went, you know, through the wicks to the bodies, you know, that type of thing. I mean, the way I'm gonna kind of view it from here, and that was a 200 week moving average too.
Yeah.
In the S&P, if we break the lows, which I'm assuming we will, personally, but if we break through the lows that we traded during the Christmas holiday week, we're probably going to be in a world of hurt. The market's going to be in a world of hurt, but I don't expect that right now. I think that the market is, you know, we got the bounce yesterday, really big bounce in equities yesterday, kind of erased those losses, and I think we'll probably continue to bounce, maybe another 70, 80 points in the S&P, you know, back up to 25, 30 before it's all, you know, before we roll back over again. I wouldn't be short risk based on the big outside day candle that we saw yesterday. Now that doesn't mean that we're going to all-time highs either. I think people have to realize that this market is under duress, and you know, there was something I was just, you know, kind of getting caught up with everything, and I I don't know how you guys treat Christmas holidays, but for me, I really detach from the market. I tried not to look at my computer. You know, as I walk past my office, I might glance a little bit at some quotes. Excuse me for yawning. I am tired. I'm not gonna lie. But as you know, as I walk by, I'll kind of glance at quotes and then just continue pushing on, and you know, into my holiday and try to ignore most of what's going on. But I was reading this this article on Business Insider. You know, it's like kind of like my People magazine, if you will, of my world. You know, it's kind of like my guilty pleasure, if you will. So I was reading this Business Insider article, how it parallels, you know, Trump right now to Nixon's final days and yada yada yada. And I don't necessarily, you know, I don't agree with that. I don't subscribe to, you know, those types of correlations. However, the one thing I do want to point out is in the event, and this is, I think you know, relatively small risk, but in the event that we get some sort of impeachment or resignation of the president, you know, the market would put us on our knees, and equities would unwind everything. And I think unless something like that happens, I really don't expect this to break immediately. Now, I do think that the tariffs and some of the policies put forth by this administration is going to really weigh on the markets moving forward. But the only way we're really going to break through these lows right now is something, you know, happens like that. Which again, I don't necessarily subscribe to that idea. I don't believe that that's something that is at risk at this moment. But you know, technically speaking, we are, and the way we have to look at this is we are really at critical support in equities. And here's your S&P, and you can just take a look at that again, kind of see where we went, kind of where we're at. And matter of fact, I should probably do this. Since we're on a weekly chart, let's take these lows back from 2016 to the highs. We're roughly, you know, trading around a 50% retracement. So, you know, again, I was telling the guys and gals in the chat room this morning, I wouldn't be selling risk down here. I mean, if you missed it last week, you know, this is not the time that you need to be chasing it down here. I think that the risk is that we bounce back up towards, you know, back above 2,500 before we eventually, you know, roll back over again. Now, there's other, you know, there's a lot of, I think we can, you know, before I pass it over to Steve and Stelios here and let them, you know, kind of catch us up on some of these crosses and what's happening in other markets, I think I can go with some majors here. The euro dollar, you'll notice that we actually failed at this major uptrend line. And when I was in New York for our holiday party, we failed up here on the attempt to 115. And so this consolidation in the dollar is not over. And I was actually thinking, you know, we finally closed above 114. Maybe that's it. And then obviously we just, you know, slump back below 114. It's like, man, I guess really at this point, the euro dollar has to take out this, you know, we can call it like 115 in order for it to be bullish, or, you know, the US dollar to be bearish. So 115 has got to break to the upside. You know, downside is, you know, we break back below 113, you know, somewhere down here, you know, roughly, you know, that's going to put, you know, the dollar back in a very bullish mode. Okay, so you know, try not to get too carried away with the dollar at this moment. All right, here's the cable. Cable's kind of you know, pushing lower. And by the way, if you guys can't see it, this is kind of what we always razz Dale here. I haven't adjusted my my Skype yet to where the notifications come up, but and you can see this is in our chat room. You can see notifications pop up from the chat room, and then we get them in the so if you guys in the chat room want to say hi, you're on Jumbotron, so go ahead. Here, let's get rid of those, and then, you know, my Skype messages jump in there too. So the cable is just kind of slumping. We can't get above that 127 level. We've talked about 127. Actually, I think, if I'm not mistaken, 127 is still our bull bear line in the cable. We got slightly above it and then slumped again. So, you know, back below 127 will, or excuse me, back above 127 would put a little bit of a bullish spin on the cable if we do that. The Aussies, the Aussie, this is interesting. So we had a bear flag pattern. I know Amanda in our, you know, Amanda Sweeney, if you don't know who she is, she's, you know, she's obviously on Twitter. She's in our chat room. She was playing this bear flag pattern in the Aussie, and it completed to a T. I mean, if you look at it, it basically flag pattern completed to a T, right to key support. Now, you may be thinking, you know, it looks like it's going to break down, but I'd be careful when we complete a pattern like that, especially if risk, you know, firms up a little bit. I don't know if I'd be short. Now, does that mean I want to be long here? I think you have a good risk reward to take a long side trade. I'm not necessarily too excited about the prospects of a bounce here in the Aussie. However, if equities firm up a little bit, you know, we might get a move back above 71 cents and maybe push back up to 72. But you can see the 200-day moving average is weighing on the Aussie. Kiwi's been pretty quiet. We're testing the 50% retracement, nothing too big. The one big mover is the dollar Canadian. The dollar Canadian continues to press higher, and I mean, it's been a very bullish move. Crude oil, we have to keep in mind, crude oil is extremely weak. Crude's having a very difficult time rallying. And, you know, as long as we stay below 50 bucks in crude, you have to imagine the crude's probably going lower. However, the dollar Canadian is really thriving off of that move in crude. So as crude oil continues to trade above or trade below 50, I think this dollar Canadian is going to stay bid. However, we are at channel resistance or close to channel resistance. Also, a long-term 618 retracement. You can see it here. This is the big 618 retracement in the dollar CAD. That comes up at 137.50. Okay, or no, I'm sorry, 136.80. We are at 136.20. So if you're bullish the dollar Canadian, you have to start being a little bit more cognizant of this this 618 coming into play. I don't think I'd be getting long here. I don't think I'd also be shorting. But you know, you see a move below that support right here, and I'll actually put an alarm on it just so I get notified too. You know, move below this, we call it 135.70 roughly. that would expose a bigger retracement, I think. So here, let me go ahead and put that on just so I know where it's at. Now, I did buy a little bit of dollar yen this morning. I picked up some dollar yen at 110.78. You'll notice that we've stopped basically at the 618, which is 110.70. Excuse me one second. I just want to drink a little bit of my coffee here. So we pulled back to the 618 of this move higher. Now this move higher obviously took place, with the big move up in the Dow. The Dow was up 1,000 points yesterday. The dollar yen finally took notice and it rallied. And it's interesting. I was sitting there looking at the dollar yen at 110.50 yesterday morning. And I was thinking to myself, man, I should just be buying this dollar yen. I was thinking about buying it. And then I decided not to. And it just ripped. I mean, it ripped to 111.40. Now, I did pick it up this morning. And I think as long as we stay above 110.70, we might have we might be building some sort of inverted head and shoulder pattern. You can see the 4-hour chart here. I think it's possible. Here, let me grab a pen. I think it's possible that, you see this little, inverted head and shoulder pattern build and maybe rally back. And then, we see 112.50. And then this is going to be, the place where you want to be on the short side. That's why I'm a little hesitant about being short risk. I mean, obviously stocks have been beat up. The dollar yen's been beat up. We came out of this triangle pretty aggressively. And, we broke that upward sloping trend line that we've been monitoring for months. And I missed this because I was in New York as we broke down here. But now that we've had that breakdown and that sell off in risk, if stocks bounce, the dollar yen could very easily push back up towards 111.50, maybe 112, or like I said, 112.50. So I think the risk reward to be on the long side here is minimal. A lot of risk, or less risk, a lot of reward, very little risk. And that's why I went long. And I'm going to try to get to a position where I can move my stops to break even and just move along and see if risk gets a little bit of a bid going into year end. There is also a risk that going into year end, you get some asset managers that put some money to work. I mean, let's face it, the stock market is down. And if the stock market is down on the year, which it is, so if you take, here's December 31st, or roughly, let's just say January 1st is right here, okay, beginning of January, right? S&P is down, roughly, let's say, right here, so the stock market is down roughly 10% thus far on the year. We've been down as much as 13%, but we're down roughly about 10% right now. So if you're an asset manager and you are down more than 10% at this moment in time, you better show that you're putting money to work, because if you don't, there's already a risk of repatriation of all these funds that are involved in the market. But you're definitely going to have people taking their money out of your fund if you're not fully allocated in this market. So you're going to get a lot of people end of year flows, in my opinion, that are going to be
redemption city.
Yeah, you're going to get redemption. I said repatriation, but redemption. Yeah, you're going to get a lot of redemptions in the market. So.
I'm a nation, so if I pull my no man is an island, but I have my own nation, Blake. So if I close my account, I'm repatriating.
Yeah, okay, you might be repatriating, but you would get, it's like that's the risk. So you want to show that you're allocated in the market if you're underperforming the market, which is already down 10% on the year. So I think there is a risk that we get some buying going into this year end, going into the remainder of this week.
You know what's interesting, Blake? I was thinking about it, not just in pure technical terms, but how they labeled the big advance that we had from Trump's election. I bet we've given back half of the Trump rally here. Maybe that's going to be a sign of his destiny if they give it all up. And I think that's probably around 2,200, 2,150. If you go back to November of 2016, wherever we were then is kind of, where everyone fell in love and really liked the job the president was doing. And you know how people are, it's about their pocketbook. And, not as many people are in love seeing what's happening to their 401k. So if we give up that whole Trump rally, that's probably a sign of what's going to happen to his presidency.
Yeah, well, that would be right here.
2030, right? Okay.
That was the low election night right there.
Yeah, that's where Carl Icahn left the party, the celebration, and went and bought $1 billion worth of S&Ps. We were limit down that night, and it came all the way back to unchanged by the next morning.
It's and it's been an amazing rally since then. And notice how much we've given back. I mean, just from that night.
Lot. Yeah.
I mean, from that night.
That night
we've given over six like 3/4 of that rally.
Yeah.
So I mean
61.8 or so.
Yeah. So yeah, I mean we get back below 2,000, and that's going to be the absolute death of this market, in my opinion. So but anyway, I think again, I'm just going to reiterate, getting bearish right now. If you missed last week, I think you got to be a little careful here. If I had to just imagine what I think is going to happen, we're going to go like this for the next couple of days, and we're going to get somewhere up here, and then then we're going to resume that downtrend going into the beginning of the year, somewhere in this neighborhood. If I had to just guesstimate. So that's why that's why I picked up a little bit of dollar yen. I don't want to get too aggressive, and I've got my stops not too far away from my entry anyway, so not risking a whole lot. But I think the risk risk reward is good here. Good morning, Steve.
Hey, also, Steve. Don't forget that a lot of people misinterpret it when we're talking about Santa Claus rally. I mean, historical studies and what's called the Santa Claus rally is actually the price action between Christmas and New Year's, which statistically has been very, very kind to the market. So that's, seasonality in essence is an extra, warning signal that perhaps, during these remaining days for the end of the year, somebody should not.
I didn't know that, Steve. That's I thought it was like rally into Christmas.
No. Santa Claus rally is considered exactly the period between Christmas and the New Year's Eve. So that's
good to know.
Yeah. For next year.
Yeah, right. No, but you're like, oh, now you tell me. Great. I bought everything on December 15th, and look what happened. Anyway, Steve, I hope you had a Merry Christmas and a Happy Holiday, and I guess Stelios should probably be here too.
Hello, I'm here.
And good morning. Good morning.
Merry
I hope Merry Christmas to you guys. And happy holidays for all of you that didn't celebrate. But I want to say thank you all for your continued support. Make sure you talk to Forest Park FX. They are our partner in these webinars. They sponsor and this webinar. Make sure that this can happen for you guys free of charge. But we also partner with them because they help you get reimbursed on your trades, whether you're doing our reimbursement program where you can be a ForexAnalytix subscriber for free, or at least partially paid through your trading, or you can get cashback rebates if you live in the United States. Make sure you get a hold of them, and you can see that in the reimbursement program on the ForexAnalytix site, and then their contact information is right here. So make sure you get in touch with them. I'm going to hand it off to my colleagues, Steve and Stelios. And again, I hope you guys had a wonderful holiday season.
Thank you, Blake.
Thank you, mate.
first of all, I want to answer. We have a question by our friend Adrian, who says, "Until what time is this webinar?" Well, it started half an hour ago. There's another half hour of analysis that we speak, and then usually there's a half hour of a guest that Dale hosts. I say usually, it's almost on a daily basis, but sometimes we don't have a guest. But yeah, so overall it's 1.5 hours to answer your question. And also, Kalimera, good morning to Dimitri and to a few other people. So Steve, this was interesting, right? Interesting few days. Actually, something I wanted to point out, where it's been very light data-wise these days, obviously, where most of the markets were shut. Yes. But we had yesterday just some minor data out of the US, and it's interesting because we had the Richmond Manufacturing Index, which normally, you're not going to put too much importance on, but it's another one of these numbers, these leading indicators that have really turned. Like for example, this manufacturing index expected 16 came in at -8. And then you look at the, and this hasn't happened, by the way, since 2008 or 2009.
A lot of things tell you haven't happened since 2008. Have started.
Yeah, true.
Right.
And yeah, true. And then you look at the sub indices, and you have one which is a Richmond Manufacturing Shipments. Previous number 12. This one came in at -25. It's like, and I look at this time series, and these numbers are just completely off the charts. So, is it a fluke? I don't think so.
Yeah,
I think
and remember the first person that actually established the concept of divergence was Charles Dow at the beginning of the previous century, and not accidentally.
I thought I did.
You were born a little bit later than that. Not a lot.
Some people. Come on, I had lunch with the guy.
So not accidentally, the first kind of divergence he actually, the divergence that he noticed and the divergence that he considered extremely important because it has a macro basis was between the Dow Jones, which he invented. In essence, he invented the first index, the Dow Jones, and the transportation part of the index.
Why? That I did not invent, but divergence I did.
Why? Because the concept was very simple. That once you start seeing that goods are being transported less and less, it means that demand is waning. So even if you still don't have signs from the rest of the stocks, industries, etc. If transportation starts showing you weakness, it means that weakness is it's a leading indicator, and it's gonna spill over to the rest of the economy. So the last one you mentioned, Stelio, works in the same fashion. I mean, if you start getting less goods shipped, that shows you something, right?
Of course, and it's these things really we should take a note, and it's not something just to glance by and just say, oh yeah, it doesn't matter, this is just another number. It's these things all add up. So I think the medium-term picture is not great.
Speaking of yesterday's recovery, which of course, I mean, both yesterday's recovery and the last day down that we had prior to that, both of them, of course, are exacerbated due to reduced liquidity, which is, a thing we always have during vacation days or half days, because some of them are like, half trading days. But I have to point out something that is not a good sign for bulls. If you go back historically and have a look at, the days that are roughly like 5% up in the indices, you're going to notice that the vast majority of them, you're going to find them in very big bear markets, because bear markets have the tendency of producing very big, 1 day or 2 day wonder rallies. You know what I mean? So the fact that we had a 5% day higher yesterday, statistically speaking, is not a bullish sign. It might be in the very short term, and as we said, seasonality would favor, perhaps more of a recovery in the days to follow. I mean, Thursday, Friday, But I think we're definitely not done. And coach, if you remember, and I know that you do remember, Blake, I'm going to grab the screen. Coach, if you remember, quite some time ago, we had mentioned when VIX was back here, and it was creating this like descending wedge. If you remember, I explicitly said that you can forget about the days of volatility that we had, like single-digit volatility. That's done. That's over. And I kept saying it despite us going down to like 12, 11. And I'm going to reiterate this. I think that we've definitely entered the last cycle, the last part of this business cycle and of this like markets rally. And yesterday in the chat room, I was specifically showing quite a few of the stocks that leaded indices higher for a long time. And as you see, for example, this is Apple. This is Facebook. I'm not gonna stay for a long time in any of those because the general point I want to make. This is Amazon. The general point I want to make here is the following. This is Nvidia, by the way. Nvidia, there it is. This is Nvidia. Just look at this, etc., etc., and you get the whole point. The reason I was showing those yesterday, I was explaining that. Listen. The technical damage that has been done to the vast majority of the stocks that were leading a risk higher for a couple of years is irreversible. I mean, the chances that those stocks during this business cycle are going to see new highs, in my opinion, have been reduced to nearly zero. Okay, of course, I'm just speaking for myself, right? This is the way I view things. So I don't expect that any of those stocks are going to create new highs in this cycle. Can we move higher from here? Yeah, sure we can. Can this prove to be like a big corrective move before we have one more leg higher? Sure it can, but I think that for every day that passes, the chances that this is going to happen fall dramatically. The move lower has been, quite impulsive. And as Stelios said, the clouds are thickening, having to do with the general viewpoint of the economy. So personally, I don't see, I consider it extremely hard for this market to manage to reverse the technical damage that has already been done to the majority of the indices, and also reverse the trend of weakening data that are coming from the economy so late in a business cycle, because we've already been in a 10-year-old business cycle. So, if you combine all of the factors together, I would have to say that the chances that we are in a bear market, and I said that, some time ago, are increasingly high. And if you remember, that's one of the reasons I decided to show you a little video of that interview from Gandlach, like what was it, like a couple of weeks ago, that he was talking about, a strong possibility of a bear market coming from here. So I do think that we are still, until something different happens, we're still in sell the rally mode in all the indices. Obviously, things in the short term are overdone. There's no question about it. But the vast majority of the indices have really broken down from major levels. Having to do with the Nikkei, we did, if you remember, those of you that were here before we stopped for 3 days for the holidays. This is the target I was looking for, which we tagged it perfectly. So, a perfect ABC completed already here in the Nikkei, and 19,000 is a very critical level. Nikkei really has to hold this, and obviously USD yen's fate will be more or less tightly correlated to what the Nikkei is going to do from here. So if we lose the 19,000 level, I think that both the Nikkei and the USD yen are going to have real big trouble ahead.
Hey, Steve, I noticed last night, I was on Bloomberg last night, and the global markets had a very muted response to the super powerful short squeeze in the U.S. Does that mean anything to you?
And not only that, let's have a look at the European markets. Today, for example, the FTSE 100 gapped higher, and since then it has created a bearish engulfing. Just look at this.
Yeah, that's what
for example,
it was muted.
Yeah,
I go, where's the jet fuel on the foreign markets? I asked myself, laying on my couch.
Same deal exactly with the DAX. It gapped higher due to the price action we had in the US stocks, and it has been selling off since. This is another like long bearish engulfing on the DAX. So as it seems, the European indices at least, they don't seem to really care at all about the price action that we had yesterday in the US. They seem to be resuming their path lower. And if you want to see some other indices that I know a lot of people are not looking at, this is the FTSE MIB. This is the Italian stock index. Just look at this. A very, very strong move lower. We've already surpassed the 61.8. This is the IBEX.
That was a volcano break.
Oh, yeah. This is the IBEX. Now, look at this. The IBEX not only has broken below this huge triangle. I mean, look at this. This is a triangle that has been forming since 2010. Wow. And the worst thing is that this is a triangle that formed after some very impulsive price action to the downside. So impulsive move to the downside, huge triangle, and now we're getting the triangle breaking to the downside. Not only that, we're also now breaking below this descending channel that at least was holding price action for some time. I didn't show that before, but this is what I was looking for. I was looking perhaps for, and we did initially bounce from this triangle support, but the bounce was a dead cat's bounce, and now we sliced through it. So, Spanish stocks also seem to be under, serious trouble. This is the Australian market. Still in an ascending channel, but if you look at this ascending channel also can prove to be corrective in nature. There is a possibility of a descending wedge, so some kind of a relief rally coming from here. But keep in mind also that the Australian market, for example, looks much better than other markets, but that's at big part due to the currency depreciating vastly at the same time. So the currency's depreciation, in essence, masks, at an extent, the stock weakness, right? So if you see, and I think we've gotten to the point that we have some statistics that are overwhelming. So, like, for example, we have more than 80% of global stocks being at below that. We have, I think, like 90% of global stocks being below their 200 DMA. I remind you that historically speaking, the 200 daily moving average is considered like, a very broad, a very general concept about, considering something being in an uptrend or a downtrend, if you're above or below, especially in stocks. At the same time, we have something like 80% plus of of global stocks that have been hitting 52-week lows. So, I mean, it looks really, really bad globally, right? I mean, I don't know with the data coming as they are, how we can really recover from something like that after 10 years of in essence, in a business, in a growth, theoretically speaking, business cycle, how we can recover from that. I'm not even sure that.
I think if central banks reverse course, like Draghi, okay, we're going to reverse course, and Powell, we're going to reverse course. That's the only thing I think that could save the markets, and it's not going to save them for 10 years. It may save them for 10 months. But
yes,
I think that's
I would agree with you.
Okay,
I would agree
that's
with
the only catalyst I could think of.
Don't forget that monetary policy is like drugs, right? And we've already had enough evidence to prove that. Meaning,
drugs.
Remember, after the 99 2000 tech bubble burst, reducing just reducing interest rates to like, what was it, 2% roughly?
Yeah.
Was enough, was more than enough for the economy to recover and build the next bubble, right? The housing bubble. After the housing bubble burst, we needed to go down and stay down at 0% rates for 6-7 years and have 3 rounds of quantitative easing to inflate the next bubble. So depends on what the central banks do, because keep in mind that if we implode from here, I don't think, I mean, and given the fact that
they don't have the same amount of ammo.
No, absolutely not. Not only that, the resistance, how I don't know the medical term, like the drug resistance that we've developed, the tolerance. Yes, exactly. Yeah. The tolerance that the economy has developed to monetary stimulus keeps increasing and increasing. So it's not only that we don't have the same kind of ammunition. It's not only that we don't have 5-6% rates to at least say that, okay, we have 5 to 6% to reduce it down to 0 and do some quantitative easing, etc. It's also the fact that we have already proven that every time this happens, we need more and more stimulus to achieve the same kind of effect we had the previous time. So this, mathematically speaking, this will fail at some point. Now,
damn the pusher man.
Yeah, can I predict if it's going to succeed for one more time and fail later on, or if it's going to directly fail? No, nobody can predict that, because we know that for political reasons they're going to still keep trying to kick the can down the road for a little bit longer. Because don't forget, the problem is that there is always political pressure to fix the problem as fast as possible in the short term, even if that means that the problem becomes bigger and it's somebody else's business to fix a bigger problem down in the future, right? So the longer we take to do something to fix the Ponzi economies we've built, the more painful the coming back to some kind of an economic real equilibrium is going to be. Now, those are, of course, are macro factors, and we don't need to care about them in the short term. I mean, we have to just see what the markets are doing. So, speaking of which,
put up a tick chart, and then it doesn't matter.
Speaking of which, let's take price action just for the S&P to show what can possibly happen from here. So we had a rejection from the second level, from the second area of resistance that I was looking for. So what can happen from here is perhaps we can get another push higher towards, for example, this level Blake mentioned, perhaps above 2,500. We might find some resistance there and then move lower from here. Let me make it very, very clear. I repeat, I'm 100% convinced that we still remain in sell the rally mode. So personally, I will be looking for opportunities to short this market and not to buy it. So something like that might unfold in the days to follow. And equivalently, what the S&P is going to do more or less, a little bit weaker, a little bit stronger, but the rest of the US indices are going to do so. No need to go through them one by one, because I want to have a look at a few of the FX pairs at the same time. Let's have a look at the metals and crude first. So first of all, gold has already surpassed my ideal target at 1262, and as you see yesterday, it got rejected from this. This is not like an unimportant trend line. You can see how important this ascending trend line support now acting as a resistance has been. Yesterday, the market already rejected it once. As we speak, we're testing it for the second time. So it's going to be quite important to see what gold is going to do from here, because so far...
You want that 631.8 maybe, Steve, huh? 1286?
Might be. Yeah. So far, I was viewing this as a textbook corrective price action, and so far it has played out perfectly as we expected, but now it has started showing some more strength. So I'm really curious to see what's going to do from this trend line resistance. And as you said, there is always the probability of overshooting that and making it to the 61.8. But I have to say that if we do slice through the 61.8 and we seem to be gaining momentum instead of losing, I'm going to start looking into this price action in a different manner, but not yet. Now, at the same time, and I was posting analysis for that yesterday. low liquidity or no low liquidity, the fact is that silver did slice through. Yes, and unsurprisingly, there were a lot of stop losses there. So once it sliced through the 1485, 1490 area, then the move higher really accelerated. So
also the gold silver ratio, silver way outperformed gold yesterday.
Yes,
so
yes, I'm going to show you. We had a nice reversal to the downside as well. I'm going to show it afterwards. So this is now a technical event because unquestionably this is a rectangle. You can view it as a triple bottom. You can view it as a rectangle. It really is completely irrelevant. Why? Because in both cases the target is the same. The target is always the height of the formation added to the breakout area, and in this case that would point to a recovery, not exactly to, but very close to the 61.8% fib that you see here from the last move lower, which is near $16. Of course, in the short term, we are currently testing previous support area now acting as resistance. At the same time, this is also the 38.2% fib, so this is a confluence of resistances, so it wouldn't surprise me if we stalled here. But even if we pull back from here, back here to the 1480, 1490 breakout area, and we do hold this area, I think that this is going to be an amazing risk-reward opportunity to be looking for more upside. So that doesn't mean it's going to work, but it means that the risk-reward is very, very appealing if we get down to 1480 for people that have not already bought the breakout to actually have a second chance of participating in that, because you're going to know you're going to have a very small risk and the potential to gain at least like $1.1 of upside, right? So I think this is going to be a very appealing risk-reward opportunity. Now, yesterday I wrote in the chat room. I know that our friend, one of our most loyal members, she followed me in that trade. I bought crude yesterday at 43. Actually, it was just incrementally below 43 because we tagged this. As you see, if I zoom out, you can see how important this 42 area was. I already think that this move lower from this confluence of supports at 45, 50 to 46 was overshooting and exaggerated. So I had already bought only a quarter of a position at 45, and yesterday I bought more at 43, and I'm still holding this position. I think that there is a very good chance that we're going to make it all the way back to at least 48.5. So I like very much that I've built a position here. My cost average is below, just incrementally below $44. So I'm already comfortable in the money, and I intend to keep that for more. Of course, I'm not going to let it run against me, but I think there is a good chance that it's going to move substantially higher. I also wanted to show copper because, as you see, copper has broken down from this triangle. It's making an effort. It's been retesting this broken triangle support as resistance, but it keeps failing here. I have a small position here as well, short. So why not? I expect that we might have a continuation lower once risk sours, which I believe it will do soon enough again. This is palladium. I believe that palladium is already showing signs of weaknesses up here. I think it's also going to fail sooner rather than later for at least like a deeper pullback. And this is, Coach, what you were talking about. This is the gold-silver ratio. It made an attempt to recover, but it never managed to reclaim that spike high. And we've had, with yesterday's candle, we've had a huge evening star formation, and we're now challenging the previous low. So the gold-silver ratio points lower. Historically speaking, this is silver overperforming gold is usually a sign that metals are going to be doing well. So that's another sign that perhaps gold is not going to fail from here. So if you combine the fact that copper seems to have broken down, the fact that silver seems to have broken up from a rectangle, and that has a target that's quite high from where we are. If you combine the fact that gold is already showing signs that it's not stalling at the confluence of resistance we're looking for, and it's trying to actually overshoot that area, something bigger might be brewing here in the metals. And as I said, the gold-silver ratio is also pointing to that direction, but I think we're going to need to see a little bit more price action, to confirm that. Crude also, very, very big recovery. Crude has been extremely battered down and can recover even further from here, even if that proves to be part of a corrective move, which most probably it is. But keep in mind that something that has lost almost 45% within like a very, very small period of time can even recover like 10, 15%, and still that being a corrective move, right? Because the move lower has already been huge, one of the biggest we've seen in a quarter ever. So keep that in mind, that a correction can be quite brutal and still be a correction, right? So that's why I had absolutely no problem buying it, and that's why I have no problem holding it, because I think there can be a lot more upside coming from there. Now, having to do with Euro USD, still in this tedious triangle. So nothing to see here. It's almost like it's pegged recently. On the other hand, I have to say that especially if you go down to a 4-hour chart, cable looks like it wants to break lower. As you see, this pattern has been clearly so far what looks like a pennant, and we seem to be breaking below it. So I wouldn't be surprised if the cable failed from here, and comparing how the cable looks with how the euro looks against the USD, I have to say that I believe that the euro pound, probably currently in a triangle, because this looks like a triangle, this is what we drew some time ago. This has already happened. But if you're asking me what I think is happening from here, I think this is a triangle, and I think that you should expect this triangle to break once again to the upside and push higher. Now, yesterday, I actually posted a pattern in play having to do with the USD CAD. I really don't know if it's going to work, but I know two things. One is that I made sure that it had a very, very tight risk, because it's clearly still in an uptrend. But since we were testing like confluence of resistances, and it's more than obvious that crude has already started like a quite an impressive rebound. I thought that it might be a good opportunity to try to top pick the loonie. So I might get stopped out, but the risk was like something like 0.3%. So something very, very tight. Because keep in mind, when you're trying to fade the trend, you might get it wrong 2 or 3 times. But what you're aiming for is a very large risk to reward ratio. So even if you're wrong like 2 or 3 times, if you're right the third or the fourth time, actually that can yield like 5 or 6 or 7 times the potential risk in this case. So loonie still looks quite, impressively strong, considering that crude gave us such a move higher yesterday. But I do think, as Blake mentioned, that this is not the place to be buying it anymore, because it's already overdone in the short term. It's already overbought. So I think that sooner rather than later, we should see some type of a corrective move lower, at the very least back towards this breakout area, 134.50, which was exactly what I was aiming for. So we might make it even higher towards the 161.8. But in any case, at some point we have to see some kind of a corrective move, and I'm going to try to sell it once again from up there if we actually conclusively break above here. Now, having to do with the USD yen, just look at this performance. Quite a big rebound yesterday, but look where it stalled. Not accidentally, this is a horizontal support resistance area that has been creating problems in the market to either to the upside or to the downside since February 2017. So we tested that, and we've reversed so far today. Now, does this mean that we're going to move straight lower from here? Not necessarily, but I have to say that given my view for risk as well, I'm probably, I'm more or less quite certain that USD yen is not done pushing to the downside. Okay, so I wouldn't be trying to bottom pick it yet. Now, of course, you can have an attempt of buying it somewhere here, put your risk below the lows, and there might be one more push to the upside for sure. So the risk reward ratio would favor perhaps some kind of an attempt to be long in the short term here. But in any case, I think that there is more weakness to follow. Kindly review Nifty bank ticker. Okay, can you give me, I can have a look at that fast before we start the interview. Can you give me the ticker for that? Because I know the Nifty ticker, it's like Nifty, but I don't know what's the ticker for the bank. So Nifty, speaking of the Nifty, I think that this recovery is corrective. So I think that sooner or later, the Nifty should fail for one more push to the downside. Nifty bank, let's have a look at it. Let's see, Nifty bank. Okay, there it is. Bank Nifty it is actually. Let's have a look at it. Okay. Oh yeah, we had a look at it together. I mentioned that this is a distribution up here. We had one more leg lower, and I mentioned that this leg higher was looking corrective. And I'm still of the same opinion. I think that this move higher does not have impulsive characteristics. So I would think that it has a very high chance of failing, anywhere at this point. So I would definitely not be buying the Nifty banks up here. I would be looking for more weakness. And if you want me to show you something that looks even more disturbing, this looks like a very nice candidate for a head and shoulders formation. Of course, a head and shoulders formation is never a head and shoulders formation until you break the neckline. But what I'm trying to say here is that if we assume that my view that this is a corrective move higher might produce one more leg lower and we get back down towards 24,000, then we're going to be speaking about something, a lot different. And that's going to be a head and shoulder formation at the top of a very, very big uptrend, in which case that's going to be a huge level, because if we lose that level to the downside, then we're going to have like a target that's going to be pointing much, much lower, because the high was almost at 29,000. The neckline is going to be roughly at 25,000. So the target is going to be down roughly at 19,000. Okay. So there's going to be a lot more pain to come if we do lose the 24,000 level, but let's take it one step at a time. Let's first see one move unfold to the downside towards that level, and then we can be having this conversation again for the potential head and shoulders formation. So, Coach, do we have an interview today? Because I really don't want to.
Yeah, we have a great one. Edward Harrison. One caveat on that bank index, Steve: if you don't get a right shoulder and it rallies to new highs, that would be bearish too, because that would set up a third drive.
A third drive, yes, you're right. That might happen as well. But to be honest, Coach, something, this price action here doesn't really have impulsive characteristics. So
good.
Personally, I very much doubt that with this kind of price action that I'm seeing, we will have the momentum to push to new highs from here.
Okay. Well, I hope we do. I'll get short up there. Anyway, thank you, Steve, as always. You had a few days off, and I know you cleaned up a little vomit over the holidays, but it did not affect your breakdown of the board at all. Okay, I mean, you're really something. Take your apron off. And Edward, I see you in the house. What a great day to have you. Appreciate you coming during kind of a holiday season. I believe you're on the phone, so you won't be showing charts. So I'm just going to make you a panelist. And let's see if your phone is unmuted. Huh. I made you a panelist. Let me try it again. Why am I having trouble here?
Do you want me to help? Tell me the name.
Yeah, go ahead. Go ahead. I mean, it might be my mouse.
Tell me the name.
Edward Harrison.
Okay, found him.
And I'm going to be the presenter.
Okay, made him a panelist, and let's see.
Verify, yes. Hi, Edward.
He's self-muted. You have to unmute yourself.
Yeah, so
yeah, there is a mute unmute.
All right, here we go.
Oh, there it is. Yeah.
Hi, Edward.
Welcome.
Thank you, Steve, very much.
How are you?
Edward, thanks for being here in between Christmas and New Year's, and what a great time to have you. So I'm going to, show your letter, and you're the author of Credit Write-Downs and newsletter. And so I'd like to start here.
Okay, great.
Because I'd like to start here on the yields here, Edward. And, with risk off, we had a nice little bond rally, and rates have been coming down for a while. So I'm interested if you could tie in a fundamental view with what I'm saying technically. So here's the 10-year yield, if you could see the chart here.
I can, yes.
Okay, so my view is, if I go to a little longer term chart, a 4-hour chart, is that yields are bottoming here, and that there's potential, since we had this move from 320 down to 275, that there's potential for yields to go back up towards between 290 and 3% again. What do you think would be behind it? And then I actually think that if we rally here and then fail, we might be targeting 240 to 220 in the 10-year. Does that line up with what you're thinking fundamentally with your background in credit and debt?
It definitely does. What I think is happening is that we're at a period of uncertainty as to where the economy is headed and how the Fed's going to react to that. And so as a result of that uncertainty, initially we had a sell-off, which was sort of a bearish signal suggesting that the Fed needed to halt its rate hike regime and listen to the markets because the economy was slowing down. And that's where we are now. The question is what happens next? Because the real economy, the numbers that we see for Q4 are actually fairly good. If you looked at the retail sales numbers for Q4 over the holiday season from November 1st to December 24th, they were actually up 5%, which is the best that we've had in 6 years.
Oh, yeah. All the lemmings were out shopping. I mean, they have jobs, okay?
Right.
They don't care about a 20% decline. But, there's an old Wall Street saying, what happens on Wall Street affects Main Street 6 months later. I want to just talk about what you're saying. So you're basically saying the real economy is still okay. And
Exactly.
Recessions don't start with decent macro data. But isn't there cases where there are financial accidents, even though the economy could be good, that could start a recession, like stock bubbles?
No, well, I think that really what you see is a lot of it has to do with credit. Even if you look at the internet bubble, the tech bubble, a lot of that in the TMT sector was as a result of a credit slowdown. That is that people basically were not getting as much credit. Credit growth was turning over, and that infected the real economy. So the way I look at it is that what we really should be looking at is what's happening in terms of spreads between treasuries and more speculative asset classes in the bond world, like junk or convertibles, as an example.
Okay. And isn't there a little something different going on in the corporate debt market this cycle, Edward, where a lot of the corporate debt is basically being rated as junk?
That's right. Yeah. So I think that what you're seeing is, one, an increase in overall leverage, and two, an increase in issuance of highly levered companies within the junk spectrum. So everything is moved towards a more speculative, a higher risk profile. So overall, we have higher amounts of debt within the corporate sphere, but also even within the high yield spectrum, you have a huge slug of single B rated paper that, when the credit cycle turns down, as I believe it is right now, bad things are going to happen to those names. And we really haven't gotten to that.
Is there a lag time between when the credit cycle just begins to tighten and it having real impact in financial markets and the real economy?
Yeah, I think, it all depends on, I mean, we're in a turbocharged era these days, so it could be that it happens much more quickly. But if you look at residential credit, that is,
Real estate?
Yeah, the
Or-
housing bubble back in the last decade,
Right.
you saw the residential property numbers, and that's where all the credit was coming from, peaking in 2005, 2006, and we didn't get an actual recession until December of 2007. So it took a good year and a half, 2 years before you got the infection from the credit markets into the actual the real economy that caused the recession. So I think that 2019 is going to be the year where we're going to start to see this infection. And then the question becomes, how quickly does it happen? I don't think it's going to happen in the first half of 2019 that we're going to have a recession, for example. We might have a recession towards the end of 2019, but the downtrend in credit is going to be a second half of the year phenomenon in my view.
Okay, and the candidate for transmission is not residential credit housing, this time it's corporate debt?
Exactly.
Okay, let me ask you this. It's it exacerbated by a decline in asset prices because it's my belief that the tax cut and also all the corporate debt that's been put out there, that a lot of these listed companies have used it for financial engineering. So basically, they've leveraged their own stock through borrowing. Is that something that you have noticed, or am I way off base here?
Well, definitely. I mean that companies basically have not been doing any capital investment. So you have record earnings and at the same time record debt. So what they've been doing, as you note, is financial engineering. They've been buying back their shares and then leveraging up at the same time. And so they're in a much more financially precarious position. That makes them levered. That means that when the economy turns down, it's going to be much more quickly that they're going to run into trouble.
Okay, so also, isn't it that they're, what could also exacerbate it is they're leveraging, like what happened in the last month, depreciating asset, and then more difficult to roll the debt on a depreciating asset, that a lot of these companies are going to end up with margin calls. Do you think that the stock buybacks that they've done, I'm not, I don't understand all the intricacies, but could they put that stock back out on the market and dilute shares because they're having a harder time rolling debt that they use to finance shares?
Well, no, I think that basically what's going to happen is that when it becomes difficult to finance yourself, it becomes difficult overall. A perfect example of that would be Tesla. If Tesla hadn't have bounced, as an example, and the whole thing kept on going down, it would have been just as difficult for them to raise equity as it would have been for them to raise debt. So you're in a bind, and because you're in a bind from a debt perspective, that makes the equity markets turned off to you. I think that the perfect example from an economy-wide perspective is to look at the microcosm that we saw in the 2014-2015 era with regard to oil, with regard to shale, the shale pack.
Okay.
Because we're seeing a similar sort of dynamic in terms of the downdraft in oil prices. And so we already saw this in terms of the shale bust in 2014, 2015, and the impact that it had in terms of capital investment on the economy meant that 2016 was a very bad year, and it caused the Fed to pause. When they said they were going to raise rates 4 times, they only raised rates once between December 2015 and 2016. And so I think that we're going to see that sort of phenomenon, but on a economy-wide basis, not just in the one sector.
Okay, so do you think that we saw the last interest rate increase out of the Fed this month? What's your forecast for Fed action, and does a lot of it have to do with whether or not the stock market is recovering, or are they stock market dependent? Obviously, Powell wasn't stock market dependent last week. Will they become at a certain level stock market dependent, because it is a cash register for the Treasury as far as tax receipts and
Well,
wealth effect?
I'd go back to your chart from before where you were talking about downside risk at 240 and then upside at 293 on the 10-year.
Yeah.
Basically, those are two different scenarios based upon the data that we get out of Q4 and the new data in Q1. Because if the data in Q4 are good, then what's going to happen is people are going to say to themselves, wait a minute, actually we've overplayed this, the data are good, the economy is going to run, the Fed is actually going to follow through with their rate hikes, and that's when you're going to see the upside scenario to the bond yields. The downside scenario is when the data are actually bad, and therefore people say, yes, the Fed is on hold, they're not going to raise in March, they might not raise in June, they might not raise at all. And that's where you get the 240 scenario that you're talking about.
Okay.
So that's where we are between those two scenarios, and the data that come out in January are going to be very instructive as to which of those two are going to happen.
All right. It's always been my contention, and, I guess you could call me, I'm always looking under the surface of what's happening, that the major reason for Fed interest rate increases and the roll off of the balance sheet, that's a little different, was to give them some ammo and insurance in case the recession you're talking about that happens at the end of next year occurs, which they'd have very low firepower at negative interest rates, real rates, and now we're not even quite at neutral. Is that your belief too, that the Fed is tightening so they're prepared for a cyclical downturn, which is way overdue since we've been in an expansion mode for a decade?
Well, they definitely have put that into consideration. I mean, if you don't hike now, when would you hike? And if you look back at all of the
2 years ago. Right, man?
Right,
The rear
yeah.
view mirror is good, isn't it? Anyway, yeah.
So if you look back over the past 4 or 5 cycles back to the Volcker days, the average cut in interest rates going into a recession and through the recession is about 5%. So the Fed basically has less ammunition now than they do in all of the previous cycles. And so given the fact that Trump passed these tax cuts and is running trillion-dollar deficits, we know politically at a minimum that we're going to have less fiscal space, because when you have trillion-dollar deficits in good times, you're going to have much more than trillion-dollar deficits when the fiscal stabilizers come into effect during a recession. And so all of the heavy lifting will fall on the Fed, and they don't even have enough rate cuts compared to the average recession in the past 5 or 6 cycles since 1980. So that's a big problem.
We're in real big trouble then, as far as depending upon the central bank to bail us out of a financial problem, aren't we? Can you speak to the big debate about yield curve inverting, whether it means something? People are trying to poo-poo it and say, yeah, it's forecasted 6 of the last 2 recessions. Yield curve inversion was pretty important in 2007-8. What's your feeling on that? Is it important? Should we be paying attention to it?
Yeah, I think we definitely should be. It's a market signal that the Fed should not ignore, and I think implicitly they haven't ignored it by rolling back their forecast from 3 to 2 rate hikes in 2019. Because if you look at the middle of the curve, what was happening as stocks were breaking down in December is that the middle of the curve, that is between the 2 and the 5 year, that was inverted. And in fact, right before we got the rally yesterday, we saw a 1 to 5 year yield inversion. So the entire middle of the curve had inverted. We had the 2 to 10 year spread at only 10 basis points. We were this close basically to the signal, and that signal traditionally has meant 12 to 18 months before the recession hits. And during that time, that's when markets are breaking down, when companies are defaulting, et cetera, into the recession. And so, now would have been the time for the Fed to back away, and that's what they've done. So I think that it is a good signal to pay attention to, and I believe that they have paid attention to it.
Okay, do you think we're going to have a depression, Edward? A lot of people are worried about, this is, the third bubble, 2000, 2008, this bubble's even bigger, financed by debt. Do you think the deleveraging is going to really be even worse than the Great Recession of 2007 and 8?
Well, I would say rather than it's being worse, I would compare this period to the Great Depression in terms of 29 to 33 recovery, and then another recession in 37.
Yeah, 37, the Fed tightened when we were starting to come out of it and took us right back down into the soup, but it took World War II for us to come out of it, didn't it?
Exactly. So I think that the risk here definitely is that we think that the deleveraging has ended, that we're out of the soup, but in fact there's a lot of risk, and the Fed, in their desire to reload for the next recession, might actually over tighten. That's always been the risk ever since they started on the rate hike regime, and we saw from October to December that risk was increasing exponentially, and so they pulled back from that slightly.
Go ahead. My associate Steve Olgi has a question for you.
No, it's not a question. Although what I wanted to say, Coach, is that I think that it's we tend to interpret monetary policy and its effects completely mistakenly often. A lot of people still blame the 37 crisis to early tightening on behalf of the Fed. As I'm sure that there will be a lot of people blaming, and Trump is already trying to make the Fed the scapegoat, the next recession to the Fed. But I think that it's completely looking things in reverse, because the Fed is to blame, but not for tightening too early in either of the two occasions, but in actually letting
being loose too long.
Letting the politicians make it out of a tough fiscal situation, putting all the tools of policy just on the monetary policy, being too loose for too long, and creating bubbles which afterwards they had no alternative, or they had only two alternatives: A, to reinflate them and just kick the can down the road, or B, to finally stop the monetary policy madness. Because when you're trying to solve problems that are at the biggest part fiscal through monetary policy, this isn't going to work in the long run, right? So I think that in this case, once again, we have a situation that began as a fiscal situation, but if they don't want to solve it,
so you can't blame the Fed. It's been really the Congress.
Blame the Fed, but blame them for what they did in the past, not what they are doing now. You understand what I mean?
What do you think of that, Edward?
Well, I'm of two minds on that. One is that I think it's the beginning of the tightening cycle. Once you've gotten a lot of malinvestment, a lot of excess in the market, is actually not, when the Fed raises rates, they're not actually tightening, they're loosening monetary policy. Because what happens is you are pulling forward demand for credit. That is, people are saying to themselves, we're debtors, we see the Fed's tightening, we need to actually increase our debt loads now
in the short term. Later. You're right. Moreover, you're very right.
You're actually adding to interest income, so it's putting more money in people's pockets. So the pulling forward of credit demand, the the addition of interest income means that in the initial stages of the tightening cycle, it's actually an accelerant. And the reason for that obviously is that the Fed has waited too long. They've allowed the animal spirits to take hold, and so therefore the whole thing is going to fall apart. But on the other side of that, with regard to the fiscal side, I think that the way I would describe the fiscal is that really we've allowed monetary policy to do the heavy lifting. Ultimately, really what we should be doing is allowing fiscal policy to fluctuate with the economy more greatly and rely less on monetary policy. So I would actually say that, you know, when we had the great recession, we should have written down lots of more debt. You know, fiscal policy probably would have gone deeper into the hole. And as a result of that, monetary policy would have been more aggressively higher. That is that the Fed would have felt comfortable raising rates much more quickly because they knew that they needed to offset the fiscal side. And so, unfortunately, we've just relied completely on the Fed to do all of the heavy lifting, and that meant zero rates for 10 years.
Yeah. Yeah, and I mean, you can tell the market's used to it if they, you know, you have this type of panic with really a neutral, not even a neutral rate. You know, last time you were on and we were having some technical difficulties, and then you sent me out a tweet, Edward, about you actually have a view on the dollar. But before we get to that, for older people, retired people that are interested in interest income or safety, where are you telling them to go into the debt structure to generate some, you know, some interest, dividend, or whatever income during what might be, you know, a storm that's gathering over the next 12 months?
Yeah, well, you know, definitely you have your bank CDs. I think a lot of people are concerned about equities. If you looked at the sell-off in terms of equities at its worst, even the Con Edisons, the Dominion Resources, the Verizons of the world, which you would consider to be fairly high dividend stocks, they were doing poorly. But I think that those, you know, consumer staples, utilities, they will actually bounce back in their low beta. You can definitely hide in those spaces. They're not going to be cutting their dividends. So I think those are definitely two places to go. And actually, I would invest in treasuries towards the middle to the end of the curve, meaning that if you look back at the beginning of the year, you had people like Bill Gross, you had people like Jeremy Grantham, you had people like Jeff Gundlach, who were all saying that the bull market in
bonds were dead.
Was over.
That was unanimous. The one unanimous thing, and I tweeted about it, was that everyone agreed the bonds had entered a bear market. You're on the other side of that.
Definitely, because at the end of the day, it's not going to be an inflationary bust, especially if you're worried about deleveraging. It's going to be a deflationary bust, and that means that you're going to end up in a Japan-like situation. I mean, if you look at where Germany is with 0.25 basis points, or actually 23 basis points today on their 10-year bond, that's an indication that people are running into those safe assets, and there's deflationary concerns over the longer term. That means the central bank is going to be on hold for a decade, by and large. That's what's happening in the United States. That's what is the risk of happening in the United States.
Okay, so you have a view on the dollar, and I think you're thinking we're very close to a significant inflection point, a high in the dollar. You know, we've basically been moving sideways. You think we're close to that happening?
Yeah, I think that basically, you know, when we got to about 97 on the US dollar index, we're now at 96. We've been trading around 96, 95, and bumping around there. That was pretty much the high. I don't see the dollar outperforming relative to other central banks, and that's because we now have a situation where the Fed is, you know, is relatively speaking, when you look at policy differentials, the monetary policy in the U.S. is slowing relative to the rest of the world. You know, if you listen to the ECB, their last policy statement, Mario Draghi was saying, yes, we're getting rid of QE. If you look at a lot of other central banks, they are, relatively speaking, in a tighter position to the U.S. So U.S. interest rates and U.S. monetary policy is, relatively speaking, less tight compared to the rest of the world, and that's not supportive of the dollar. That means the dollar should be weak relative to other major currencies.
Okay, so the argument that demand for dollars is a big natural thing, not only because it's a reserve currency, but because most debt is dollar denominated, which creates a natural demand and shortage for dollars. You don't buy into that.
No, I definitely buy into that. But, you know, we're talking about where are we in the cycle? Because, for instance, if you look at China as an example, I think that the Chinese are leading the way. You know, we were literally 5 or 6 months ago talking about 7-to-1 of the yuan to the U.S. dollar, but now it's more like 688. It's moving in the opposite direction. That they started that move, you know, because that's where the downward impulse in the global economy started, and it's been metastasizing and moving out to other places. And so this is happening elsewhere. At some point, you know, the credit cycle in the United States is going to be infected enough that you know, the U.S. is going to go down as well, and then that's when the sort of the financial market impact in the credit markets will happen. That's when people will start to want dollars again. That, you know, when there's a crisis, people will flee to the dollar. But until that crisis happens, there won't be the flight. I think we saw the same thing in 2007, 2008, that the dollar was plummeting right before the crisis relative to the euro and other currencies. And then as soon as the crisis picked up, everyone started to rush to the safe havens. And, you know, I think that's probably going to be true for the yen. It will be true for the Swiss franc as well.
What a great interview, Edward. Thank you so much for coming back. You know, a lot of people taking the rest of the year off, and, you know, your views on the credit markets and rates and the dollar. Really appreciate you edifying our community today, and I encourage people to go to Edward's newsletter to stay informed. And here it is. What's a website for people to get there, Edward?
You can type in credit write-downs or www.creditwritedowns.com, and that'll take you right to the newsletter.
And your Twitter handle once more for our audience and people to watch the video.
That's Edward NH. So Edward and then N and H.
Okay. Well, Happy New Year, my trading warrior brother, and let's keep in touch and do this again, especially as we move towards your window. We'll get together at least another time or two before we get to the end of next year, and appreciate you being with us. And I learned from you today, Edward. Thank you so much.
Thank you, Dale. It was good talking to you, and Happy New Year to you as well.
Okay, guys, so that's a wrap for us on Thursday. Thank you, investing.com, for tuning in. And we'll see everyone to wrap up the week tomorrow. Remember, don't just count your pips, count your blessings. I count being part of the ForexAnalytix team as a blessing in my life. And all you guys that come in here to listen to us, as someone said today, blah, blah, blah. So I'll see everyone. See everyone tomorrow. Adios. Good hunting the rest of the day. Edward, thanks once more for being here and sharing your insightful views. Adios.
Take care.